Good morning, everyone, and welcome to July's Market Insights. For those of you who might be new today or are watching on video later, I am Paul Nalabondian, your local market expert and host for these monthly sessions. I am an attorney licensed in the District of Columbia, but more importantly, for these sessions, I am a top producing realtor licensed in Virginia, Maryland, and DC. I'm with Fulcrum Residential. We are one of the top real estate teams in the country, as is my colleague Temi, who should be joining us momentarily. And we are all licensed with Williams Capital Properties. I will wait to introduce Temi. Oh, here we go. Welcome, Temi. So, Temi, would you like to introduce yourself to the folks on here today?
Hi.
Short, sweet, and to the point. Temi always has a little nickname, nom de guerre, for these sessions. I was suggesting today it would be Temi technical difficulties, Akoji, because we've been having a little bit of trouble lately. It sounds like your audio isn't super clear. I think you had to switch over to mobile because we were having. So hopefully everyone else can see you and hear you. We are going to get started in just a moment. I will run down the format, same format as always. But first, we are going to go to my favorite segment. One of my favorite segments has nothing to do with real estate, but coffee of the day. This is from Black and White Roasters. They are in Raleigh, North Carolina. This is from a Black Label subscription that is, I've had that for a while. They're incredible S-tier beans. And this is from Diego Bermudez in Colombia. It is a washed advanced process geisha. This one in particular, it is called the Luna Geisha after his oldest daughter. He has coffees named after all of his daughters and his son as well, which is pretty neat. So cheers to everyone else who is out there joining us today. Hopefully some of you are enjoying a delicious cup of coffee as well. Actually have a new format today to allow for the chat. Boom, there we go. No longer blocking the presentation or either of our faces. Good morning, Mark Lenkowitz, our wonderful lender partner with Envoy Mortgage. Just a wonderful loan officer, actually closing a transaction with him a little later today, and also love his expert insight here. I can tell you what my clients are locking in at with mortgage rates. I can tell you what's being reported, but Mark just has a wealth of knowledge as far as what people are getting in various entities, various areas, at various levels of financial security. So great to have you on here. Great to have you on here, Christopher and Maggie and everyone else. For those of you who haven't chimed in yet, if you want, you don't have to. If you don't want this to be just comfortable, relaxing, and informative. But if you would like to chime in with where you are, if you are a consumer, if you're someone who's looking to buy, looking to sell, or an investor, talk about what area you are looking in. If you are an agent, would love to hear where you practice. And if you're a loan officer, already said hi to Mark, shout out, or title, just kind of say hi. And more specifically, I like to make this as tailored as possible to the present needs of the community. So if you have any questions, please just let us know in real time. Temi, the great Temi, the World Cup of Tea, Temi technical difficulties, Akoji will be on the ones and twos all session, moderating the chat, doing the wonderful job that she always does, despite my mild ribbing today. I love you, Temi. It's nice to have you back on here. Couldn't imagine doing this without you. So yeah, like I said, just keep the questions coming. If there's anything in particular you want to cover today, let me know in the chat and I will try to hit it if I can. We're going to follow the same format we usually do. The underlying information varies, but we try to stay consistent in what we cover. I pretty much try to hit everything that would be relevant to an agent, to anyone in the industry, but to also somebody who's looking to buy or sell a home, and try to do that as succinctly as possible in the hour we have. So we are going to start out looking at the economy and mortgage rates. We look at the economy because that impacts the mortgage rates. We will also be talking a little bit about the Iran conflict because it is not over yet, and that is having a big impact on both the economy and the real estate market locally and nationally. And then we're also going to take a closer look at the DMV economy, where we all live, how things are going. Then we will transition into real estate specific data. We will look at June, the most recently reported month by Bright MLS. We will look at all of the relevant and important statistics from June. Then we're going to take a look at the most recently reported weeks, which is the first 2 weeks of July, month to date in July, get the most accurate and up to date information. All right, let's get rolling. Where are mortgage rates at? I will tell you what people are reporting. I can tell you, like I said, what my clients have locked at. Would love to hear what your clients have locked at. If you're a consumer and have locked a mortgage rate recently, I would love to hear what that rate is. If you're an agent and have clients that have locked, can you let us know what that rate was? But also let us know whether it's fee simple or condo. And then you can share kind of like how great, credit score, debt to income ratio, all of that stuff. If you want, you could just say rock solid in this because that impacts. So that's kind of helpful to have that color as well. Tommy K, great to have you on here. I know you're on here all the time, most of the time. Love it when you chime in with your comments and chats. Tom Cavanaugh, one of the top realtors in the area and all around good guy. 6625, Mark reporting for FHA and VA right around 6. Yeah, those are really good rates for FHA and VA. That's lower than what's been reported. And as we'll see here, so this was as of Tuesday. Yesterday, they crept up even further. So as of yesterday, mortgage rates were basically at an 11-month high, up 20, 22 bips since we last met. And, all directly related to tensions heating up in the Middle East and Iran again. The DeBoy 981-625 on FHA, also great. Love that additional information. And yeah, so that's right around what we're reporting at here. I'll just go here. The breakdown right now, 30-year right around 675, 15-year a little lower at 62, jumbo bit higher 687. Jumbos are kind of a weird entity. If you have if you're fairly affluent, have access to private banking options, oftentimes those right now can be your best sources for jumbos or credit unions. Sometimes with entities trying to get your business or smaller shops, you can get more preferential rates. But right now, the general jumbo that's available is not that great. ARMS, quarter point lower, not that great. But as Mark said, the FHA and VA is offering some pretty decent rates here, and you're able to get some rates close to 6, even lower than what's being reported. Okay, just want to pop back for a second and just show that this is, and I'll talk more about this as we go forward, but really it's as the conflict in Iran goes, mortgage rates go. You can see my vertical line here. That is the day before strikes began. Mortgage News Daily was reporting 5.99%. On the 30-year, right after the conflict began, it shot up. And you can see where these dips are. That is when people thought the conflict would end or the ceasefire was signed. Where the spikes are, that's where tensions were renewed. People thought the conflict was going to continue. Also related to the Strait of Hormuz, whether it was open, whether it was closed, whether it was open part-time. That's where all of those peaks and valleys and spikes are. And that's something to keep an eye on as you go forward. If your clients are asking you where mortgage rates are going to be at, just take a look at what's happening in the conflict. And if things are settling down, if it looks like there is going to be peace, mortgage rates are going to drop. If not, they can continue even higher. And like, if this thing gets really, really bad, it's almost like sky's the limit because inflation will just be spiking. We'll talk more when we talk about the Federal Reserve, but the Federal Reserve might actually hike rates. And there's kind of no end in sight to how bad this could all be. And of course, it's the worst element of it is, human suffering and all of that stuff relating to real people. But I'm just talking about here. I'm not talking about how I personally feel on a human level, but I'm just talking about specifically here within the real estate and economic context.
And someone put in the chat that they saw a 6.25 for FHA. I would just say just make sure that that's not a buy down, because I remember when rates got up to 8%, we were seeing lower rates with certain banks, but the fine print was that you had to buy that rate down. So this, just be mindful when you see like lower rates compared to other banks. Make sure that that's not something that might possibly be a buy down.
Yeah, great point, Temmie. And I know I often see incredible rates offered by a lender. I'm not going to say who it is, but their name rhymes with schmocket schmortgage. And I will see incredible rates offered by them. But when I have real world clients inquire into it, they're not able to get those same rates. So yeah, just shop around, get a good rate, but it's also important to get a good lender. Shout out to Mark Lankowitz. Okay, moving on. How are people feeling about the economy? I mean, it's kind of challenging to be feeling wonderful right about now because there's just a lot of uncertainty and what we're going through. If people want to mention how they're feeling about the economy or how your clients are feeling, if you're an agent, just say when I get calls from my clients, what are they saying? Are they saying they're worried? Are they saying they're confused? Or are they leaning on you for advice? Would be interested in hearing any of those specifics, but going to talk ever so briefly, not as much detail as I have in the past, but why do I talk about the economy? And why do I talk about all of these things? The Federal Reserve, the funds rate, tariffs, trade policy, retail sales, inflation, jobs, all of these things that make up the economy. Well, I talk about them because they impact the bond market and the MBS market, mortgage-backed securities, and that's what determines where mortgage rates are at. You have to understand all of that in order to have any idea of where mortgage rates are headed, and even for experts, it can be a little tricky. I've gone into great detail in this, not going to do it today, but if you want to go back, where is it? January session chapters are labeled. It's at 1021. If you want a more detailed explanation of how mortgage rates end up where they're at and why I cover all of this stuff, go to my January session, 10 minutes, 21 seconds, give a very detailed explanation. But just want to say briefly about this connection. It's just overly simplified in the way I present it, but try to make it digestible with enough detail to make sense. But just a clear example is yesterday, bond yields were up. The bond yields were up to basically their highest point of the year. And then yesterday, mortgage rates were up to basically their highest point of the year. That's not a coincidence. It's because mortgages are packaged into mortgage-backed securities where they have to compete with other investments. And I mean, when you have inflation shooting up, when you have the cost, like basically the value of money decreasing for these fixed return investments, you have to offer a higher rate in order to sell them. So there you go. And Temmie, sorry, just a little background talk. Normally I'd text you, but I just want to keep rolling. So are you able on mobile? Are you able to also pop comments onto the main screen, or should I be paying closer attention to the actual chat?
I'm going to try to jump on one more time on my laptop and see if I can do that.
Okay. If like Temmie's amazing in just keeping an eye on things and popping them up so they're more prominent, and I can just kind of keep grinding through and then respond to comments as she presents them. So if she's not able to do that, then it'll just be a little bit more like when I'm doing it by myself, and I'll just take little pauses and take a look, which I will do right now and say, good morning, Casey. It's always wonderful to have you on here, our incredible team leader at Keller Williams Capital Properties. And Maggie mentions that uncertainty seems to be affecting buyer psychology as much as affordability. And that's totally true. I mean, you're talking about here, if you're buying a property, particularly for a first-time home buyer, it is for a lot of buyers, this is your most valuable asset. It's a very big decision. It's not something you should make lightly. And it's a little challenging to be making those very important, most valuable asset type decisions when there's so much uncertainty going on in the world, in the economy, with mortgage rates, with the market, and things seem to be changing every day. So you'll see, spoiler alert, one of my big takeaways is like for agents, kicking back on the corner and just having business pour in, easy market is over. You need to be providing expert advice to have any chance of your clients understanding what they should do in this volatile situation. And then if you're thinking of buying or selling, same thing, just rely on experts to put you in the best position possible. Okay, GDP growth. So since we last met, The third and final report was given for GDP in Q1 2026, released at the end of June. That was revised up from 1.6 to 2.1. So strong growth and a meaningful uptick from Q4 when we were at 0.5% there. But one of the things to note, and so there's this stuff is incredibly complicated and there's so much data going on. So it's tough to speak in absolutes, but there's a fair amount of analysts out there and looking at the underlying data is that basically AI investment is accounting for all of our growth in GDP right now. So just kind of keep an eye on that. And also the stock market, when you see the stock market going up, AI and AI adjacent companies account for about a third of the total value in the stock market right now. Same thing for S&P 500. If you just look at the top tech stocks, they account for about a third of the value in the S&P 500. So right now, it's just everything is valued so high and having such an outsized impact on the market, on the economy, on all of this stuff. And it's just keep an eye on what's happening with AI. People talk about the AI bubble, and there are reasons why it might not be as problematic or worrisome as some of the articles tend to say, but it still have a lot of very, very, very high valuations, a lot of money pouring into things. And at some point, there's going to have to be a return on that money, or the economy is going to head south and could happen in a hurry. Okay, Atlanta GDP Now model. It's interesting. Usually they are at the upper end of where people are predicting GDP to go. Not so much right now. You can see recently it dropped down quite a bit, rebounded. Now they're right around the middle of where blue chip estimates are going for Q2 2026. They're estimating growth of 1.7%. The New York Fed is projecting higher, 2.8%. Anywhere 1.7 to 2.8 is still a vibrant, nice quarter. But like I've said in the past, even if that happens, even if the economy is still in an overall level as far as gross domestic product growth is increasing, that doesn't mean everyone is doing fine, because those at the lower end of the income spectrum are being squeezed a fair amount. And I'm sure a lot of people out there are feeling this and know what I'm talking about. Yeah. Yeah, Christina, nice choices. Yeah, that's definitely, we've seen a lot of growth. And that's another thing when I was talking about retail spending, and retail spending has been stronger than most experts have predicted almost month after month. And one of the reasons for that is you're having anybody who's invested in tech, invested in AI companies or AI adjacent, they have seen massive gains in equity, and some of them are cashing some of that out, and it's providing a lot of disposable income. Okay, I've had this slide in here for months now, but the conflict is still going on. So just want to include it if anyone is joining us for the first time or wasn't paying attention in past months. What is the impact of the Iran conflict? So, immediate impact, you're having higher oil prices, higher gas prices, increases the cost for any goods and services, which means higher inflation, stress on the economy. The longer this goes, there's also a lot of food flows through that region. You have fertilizer flowing through that region. Fertilizer costs have gone up, which increase the cost of farmers. Farmers are already being squeezed. It's just making that process much more challenging. And then higher inflation will mean higher treasury yields, higher mortgage rates, and all of that leads to a higher risk of recession. If the conflict continues, I think it'll eventually push the globe into the world into a recession. Hopefully things will get set before then. Sorry, I'm taking just one more look to see if I can get Temi on here. Okay. Not sure what is happening there. All right. Okay. All right. Not sure why that is happening, but let's see. We'll get Temi back. Okay. Last thought, Temi, is maybe if just try the if all else fails, maybe rebooting the laptop, trying one more time. If not, we are just going to carry on, and I will squint at the chat box and take care of it. Okay, Moving on now. So, how are people feeling about the economy? So, not as bad, but that'll change. The reason why I say that that'll change is both the University of Michigan survey and the Consumer Conference Board. Both of them reported higher consumer confidence, but both of those were also directly impacted by falling gas prices. Now, since gas prices have spiked, which they have, we don't have new data from these surveys. When we do get new data, I'm sure it's going to say consumer sentiment has fallen, because basically how things have been headed since February is conflict spikes, gas prices spike, consumers are worried, sentiment goes down, conflict recedes, gas prices recede, consumers aren't as worried. I mean, it's like set your watch to it. So that's what is going to happen. Consumer sentiment will be dropping since this has heated up. Okay, taking a closer look at, not everybody is from the DMV. I know we have people joining from all over the country, but for those of you who are in the DC metro area, I want to take a closer look because we have not been doing as well as a lot of the country lately. But for employment, at least, we've kind of rebounded. So the Doge layoffs hit. Our unemployment levels shot up. Employment was much weaker in this region than it had been recently, and then also much weaker than employment generally in the country. We're seeing that rebound. A fair amount. So DMV wide unemployment dropped to 5.1%, still above the national average of 4.2, but coming down, and it was as high as 5.7 recently. DC proper also dropped down to 6.1. Frederick, Gaithersburg, Bethesda dropped to 3.6, which is lower than the national average and down from 4.5. And then Northern Virginia, the only segment of our metro area that had higher unemployment, but that was up only to 3.2, which is a full percent lower than the national average, lowest in the area, but up a fair amount from last year. It's also interesting to note that Frederick, Gaithersburg, Bethesda, that area was the hardest hit by the federal government layoff. They had the highest concentration of federal government employees who lost their jobs. So seeing their unemployment rate drop down really shows you that we already knew that. A lot of these people being let go from the federal government or choosing to leave were highly skilled, highly valuable, sought after employees. And it shows here in the data that they're not having a whole lot of trouble finding other jobs. So since we last met, local GDP is always on a lag from national GDP. Since we last met, the Bureau of Labor Statistics released our local area GDPs for Q1, and there was a pretty strong rebound from Q4. You can see there Q4, like the whole area was negative, and DC in particular by a very sizable amount. In Q1, it rebounded. DC had a quarterly growth of 2.2%, Maryland 1.5%, and Virginia 0.5%. So DC, outperformed all of the areas in GDP growth, and they also outperformed national GDP. But don't take that to mean that the economy is going great in DC, because it's not. That's a result of two things. One of those things is that federal government ramped up expenditures, and a huge portion of the DC GDP is federal government. The second thing is in Q4, DC was negative 8.3%. So with a 2.2% growth in Q1, they're not even back to anywhere close to where they were before Q4. So there's a lot of ground to make up. And that goes for the whole area. I mean, the economy was just declining. So even when you have a jump after that, they're still not back to where they were before. So positive, moving in the right direction, but our economy is still lagging behind the country and a lot of areas. And then here's just another addition BLS is reporting. This is per capita personal income change. And all areas in the DMV are below the national levels. Maryland and Virginia have improved from Q4. DC has taken a hit, but you can see the United States is orange on that bar, and all of the core areas in the metro area here, income growth has lagged behind that of the country. Yeah, and Maggie comments GDP growth doesn't always reflect how consumers are feeling. And that, at least like in my lifetime, or since I've been paying close attention to this stuff, I would say there's never been a time where that has been more true than right now. Just that, the upper echelon of income earners are accounting for a greater piece of like basically total wealth in this country, and they're also driving GDP. So between the top 10% of income earners and AI investment, that is driving a lot of GDP, and people at lower income levels are not seeing the same wage growth. They're not seeing the same opportunities, and it's pretty challenging. Speaking of challenges, consumer price index, inflation, the most recent month over month was 0.4% increase. So that's kind of stabilizing, getting a little bit better. That dropped down from May's 0.5, down from April 0.6, and down from March's 0.9. So that's great, but those were two of the worst inflation months in the last 2.5 years. So that's something. Decreasing energy prices were the driver of this, and so that's what allowed for these month over month numbers to come down. Food and shelter were going up, countered that a little bit. But as I've already said, energy prices are spiking back up. So unless something dramatic happens through the end of July, this is going to be reversed, and inflation is going to spike again because energy prices have already done so. Going back to the 12-month, so the 12-month all items is at 3.5%, down from the high of 4.2 in May, 3.8 in April, 3.3 in March. But let's not forget, before the Iran conflict, inflation was at 2.4%. So more than 8% higher than it was pre-conflict. And like I just said, energy prices are already spiking back up. So we should expect to see this number even higher next month. And then I need to put a segment called Paul the Optimist, because I really am an optimist. I feel like so much stuff I talk about here is negative, but I just try to accurately reflect the data I'm seeing. So accuracy of these CPI numbers. We've already talked about what the numbers are, how they're all elevated across the board. We're seeing much higher inflation than we were pre-conflict. But how much stock can we put into these numbers? And it's like, I don't really know. Talked about different cell imputation. In short, that is when the Bureau of Labor Statistics, they have these enumerators going out checking prices. They look at specific prices of specific things in specific areas. If they can't find those things, then they impute a price from the exact same thing in another area or something similar in the same area. They are way short on enumerators. They are not able to check all of the prices, and they're having to do much more of this different cell imputation, which is essentially an educated guess, a very, very expertise laden educated guess, but it means that CPI data is not always based upon actual concrete data, what's happening in the marketplace. And you can see here, 39%. The June CPI numbers were made up of 39% of educated guesses, and that's been happening for quite a while now. Prior to last year, this number was never higher than 10%. So you had 90+% of the CPI inflation data based upon actual prices of actual things. Now we're hovering close to half guesses, and there's a lot of pressure to make these numbers look good. I would hope that's not happening, but even if everybody's doing their best work, it's still just the accuracy of this is nowhere near where it was. It's just not possible. Okay, going back to the jobs report. Past 3 months prior to June, we saw six-figure additions in the job market, kind of strongest jobs additions in quite a while, even though the past 2 months were downwardly revised. I think 40,000 jobs were taken off of April and May. But this most recent month, dropped a little bit. 57,000 jobs were added, so a little bit slower. And surprisingly, professional and business services accounted for a big chunk of that. It's basically professional and business services, social services, and healthcare. And we talked about healthcare and social services have been propping up the job market quite a bit. Professional and business services, a third of those jobs were temp workers. And so I look at this as like, okay, maybe this actually is some kind of sign of a little bit of uptick in the job market, because a lot of times that's the first sign that the job market is strengthening, is when you have companies hire temp workers. A lot of times they turn into permanent employees. But the counter to that is that we're in a low hire, low fire environment. We have been for quite some time. And so businesses, instead of actually staffing their needs, they're hedging against uncertainty and using temp workers to fill what they would normally use permanent workers for. So hard to say exactly where that's headed. Unemployment rate 4.2 dropped to 0.1%. We've been in kind of this similar band for a while. Just like I said, low hire, low fire. Everybody's just waiting to see what is going to happen. Okay, what is going on with the Federal Reserve. We talked about last month that they met right before we did. They met the 2 preceding days prior to last month session, and nothing happened as far as rate change as was expected. The big thing to note, it was the first meeting for Chairman Warsh. They meet again next week on Tuesday and Wednesday. Most people expect no rate change. There definitely won't be a rate drop. It's possible there could be a rate hike. You can see, actually, before I go to that, I just want to say, since we last met, the Supreme Court ruled at the end of June on the Trump v. Cook case where the administration tried to fire federal governor Lisa Cook. The court said that they couldn't do that because they had not presented sufficient evidence of cause. It was remanded to the lower court, essentially saying, like, if you want to fire her, you have to prove cause. So now that is being played at. But between that and the criminal investigation of Chairman Powell being closed, for a while, there was a little bit of uncertainty as to whether the Federal Reserve would maintain the independence that has been just the hallmark of that institution and what everybody relies on. And those two things happening have at least maintained, for right now, the Federal Reserve is independent and a vibrant institution doing the work they need to do to help stabilize and maintain our economy. Okay, now going probability of rate hike or cut. And so take these things with a grain of salt. This is based upon what is happening in the market. And like recently, the market probability of a rate hike at this coming up meeting next week went up to 30%. That doesn't mean there's a 30% chance of rates being hiked. I don't think rates will be hiked. There would just be too much political fallout. And not that they're making political decisions, but it's just we're not at the point yet where it has to happen. But the environment for it is making it a lot more likely. So just want to note that basically, since we met last month, the probability of a rate hike sometime before September has doubled from 40 to 80%, according to the markets. And this number has actually jumped by 10% just in the last few days. The analysts in federal government or federal governors actually split prior to the Iran conflict. Pretty much everybody thought there would be 2 rate cuts before the end of the year. Then we reached a point where nobody thought there would be a rate cut, just maybe a rate hike. And now we're at the point where nobody thinks there will be a rate cut, but the chances of a rate hike are 50-50. I think half of the governors who talked about where they see things going, I think half indicated a hike might be necessary. 10-year Treasury, this has probably jumped up again. So this is back up about 25 bips since we last met. No surprise. All the things I'm talking about, they put upward pressure, like when yields are popping up in the bond market. This is in the larger bond market competing for the same asset class or investor class, rather. Sorry, I'm trying to do 2 things at once. Yep. Okay, so the 10-year right now is 4.715. So it's bumped. I mean, every time I look at it, it's up 5 bips, and that's going to continue to happen as long as the conflict continues to escalate. And I think I'm behind. Yep, behind schedule. All right, we're going to kick this into high gear, get to real estate very quickly. Retail sales were up 2% in June. If you want to do some simple math with me, if inflation is up 0.4%, if retail sales are up 0.2%, that means sales actually contracted. This data is based upon total dollars spent. So that means that the stuff bought in June was actually less than the stuff bought in May, but higher prices caused that bump. Industrial production and manufacturing. So this is kind of interesting. You have industrial production increased by 0.1% in June. Manufacturing output has been unchanged since April. Manufacturing not doing great in the country overall, but it did rise at an annual rate of 4.7% for Q2 in 2026, and that's the highest quarterly rate since 2021. That's really being driven by tech and AI. You take out the AI in manufacturing, and it's been stagnant. So that 4.7 quarterly bump is all due to AI and tech investment. Okay, now we are at the, I would say, pièce de résistance, but that makes it feel like, kind of the final conclusion. We are just at real estate specific data, what a lot of us are here for, what a lot of us deal with every day. I would like to hear, and I'm going to take a sip of coffee and a sip of water, what how are people feeling about the market? What are you reading about the market? What are your clients telling you? What are you seeing out there? And in particular, if you've gone under contract recently, either on one of your own listings or one of your own buyers, if you could share, was it a multiple offer situation? Did you ratify at a price higher than list price, lower than list price? Well, how competitive did you have to be? That's the kind of information that's harder to glean from the data. I can see where prices are going, and if prices are going up, obviously more competitive. If prices are going down, less competitive. But the specific granular level, the macro information is impossible to get outside of what's happening with me personally with my clients and people I'm talking to. So any additional intel on that would be wonderful.
Yeah, Maggie makes a good point. She said the uncertainty makes setting buyer expectations even more important. I feel like the buyers that I have now that are purchasing because they have to, like they're ready, like they need to move to the next home. Um, I'm not getting as much buyers that are kind of like, I don't need to move, but I want to move. So it's that with the higher interest rates and everything, people are purchasing because of there's a definite need versus a want.
hmm Yeah, I'm seeing a lot of that too. Thank you for sharing, Tammy. The unfortunate thing about that is that there have been some buyers who have been doing that now for years, thinking we're going to be back at 4 and 3 and just waiting. And all that has happened in that time in most areas is houses have gotten more expensive. And even now, I would talk to some buyers when rates dropped down to 6.5. They said, okay, well, once we're just going to wait a little bit. Like we're getting to the point where we need to buy a house. We've just waited so long. But the conflict's over, rates are dropping. Once they come back to 6, then we'll buy. Excuse me. And now all of a sudden they're back to 6.75, 6.77. And like I said, sky's the limit if this continues and if inflation continues to spike. So if most people can't wait forever. And the problem is if you keep waiting and keep waiting, then you might find yourself in a situation where you need to make the move and the circumstances might not be as ideal. Like I said, not to mention it's just, yeah, rates haven't dropped down, but property values are a lot higher in a lot of areas.
Also,
Okay.
definitely seeing a lot more people take advantage of temporary buy downs because of this.
Mhm.
I wasn't a fan of it in the beginning because the idea of having your payments being a certain way, and then they're going to go up already because of taxes, but then knowing in 2 years it's going to go up. I wasn't a fan of it, but now just with everything that's going on, it really makes a lot of sense.
Yeah, yeah. Well, that's I think that's a conversation for another day. I mean, it's a very valid point, and it's great if you can get the seller to pay for a rate buy down or the lender to pay for it. I mean, it's like the money comes from somewhere. So if you could get the seller to pay for a rate buy down, you could have gotten the house at a cheaper price. But basically, if anyone's a consumer on here not aware, with a rate buy down, essentially all you're doing is if you want your rate to be $200 cheaper for a year, you're prepaying $2,400. Like you're just prepaying that amount, and then it makes the rate cheaper. And now, for a variety of budgetary reasons, it can make sense. And like I said, depending on who's paying for it, it can be a good thing. But yeah, it can also be a little tricky if you are setting your max budget at that reduced rate, and without increase in income coming, you could be in a tight spot when that thing rolls off. Okay, looking at historical context, kind of where we at. The market had been heating up from early in the year. We had started the year in like the mid 40s projections. Now we're up to 50,608 as of the end of June. That would be the first time we've had 50,000 transactions in the DMV since 2022. Prior to the start of the year, Bright had predicted 54,000 transactions. So we are still behind expectations. And I would say all of that has to do with the conflict in Iran and higher mortgage rates. And that's directly impacting our mortgage or our market here. But we are still, like I said, still on track for a little bit hotter market than we've seen in recent years.
And Paul,
Now
we have
going
some
on,
good comments. Sorry, we have a few comments.
advertising
I'm
the buy
seeing,
down is cheaper than a price drop. Yeah,
yeah.
go ahead.
Yeah, and just seeing a lot of Christina talked about seeing a lot of buyers approved for way more than what they're willing to spend. Yeah, being price sensitive. Yeah.
Well, it's just when there's so much uncertainty, people tend to be more conservative, as is valid, as am I. As so it's like it's like anytime you make a decision, if it's an informed decision, that's the right decision for you. The main thing is just get information and make sure you are making an informed decision. Yeah, and Tommy like makes a great point is that it's like, yeah, the buy down can be a very effective tool for sellers. And I would say that's maybe where a lot of your value is in that as marketing that to help you sell a property, maybe if you're struggling just a little bit. Okay, so going on to DMV sales price and something if it sounds like I'm saying this every month, it's because I am. So DMV median sales price appreciation in the DMV is going very strong. Prices have been up now for 37 straight months. So we have more than 3 years of year-over-year price appreciation every month DMV wide, 37 straight months. And year to date, median sales price for the metro area is up by 3%. And then for the first time in 26 months, since April of 2024, we actually have fewer days on market than the same time as last year. One thing I've been saying recently is two things you can count on is increasing days on market and increasing prices. Well, the days on market have pulled back just a little bit. We're at a median days on market of 11 compared to 12, but that has more to do with days on market already being higher last year. I took a quick peek, and other than last June's 12 days on market, this is the highest June days on market since 2018 when it was also 12. Closed sales. Closed sales were up by 4.4%, which is fairly surprising because pendings were basically even last month. Usually you'll see a bump in pendings the preceding month if you see a bump in closings after that. So that was fairly surprising, but nice bump in closed sales, up 4.4%. That's now 4 months in a row of monthly year-over-year increases in closed sales after being down for 5 straight months. Don't expect that streak to continue. We're going to see closed sales down next month. You can already see here, pendings were down for June, but then into July, pendings have taken a hit as well. Going on to new listings. New listings have really been a roller coaster, and would love to hear from anyone on here who's listing a lot of properties what your clients are doing as far as making decisions. And I think, again, it has a lot to do with the conflict, a lot to do with what's happening in the economy and the world, and making decisions where things look like they're going to be a little bit better. Sellers make a decision to sell. Things look like they're getting a little worse. Sellers make a decision not to sell. So it's been alternating between up and down. This in June, it was up. New listings were up by almost 4%. But just running back, so new listings were down at the end of 2024 and down the first 2 months of 2025. Then they were up again March through June. Then they were down July through August, up again September through October, down November, basically even in December, down January through March, up in April, down in May, up again in June. So that is just, I mean, that's unreal. Like, I can't remember seeing kind of a data set where you would expect a little more consistency to be that all over the place. Active listings. Now, another thing that has been fairly consistent, one of the fewer things that has been consistent, is we are seeing an increase in active inventory, active listings. Those were up 9% year over year. We've now had 29 straight months of monthly year over year increases in DMV-wide inventory. And you can see here from the orange bar that we are now, inventory is at the high end of the last 5 years. But like I've said, the last 5 years have had unnaturally low inventory. I like to look back to 2019 as the last year we had of normal inventory. And even though we're up almost 10% year over year, you can see we're at the high end of the last 5 years, we're still at only 88% of the active inventory that was on the market in June of 2019. And the area had a slightly smaller population there. So it's even more than the actual number would say. And we're only at 82% of the inventory levels of 2018. So still DMV-wide inventory is a little low. Some areas are past their 2018, 2019 inventory levels, in particular Northern Virginia, who had no inventory in 2018, 2019. Very competitive market. Okay, moving on. Yeah, and that's Mark. Mark was sharing that they have a paid buy down special, a lender paid buy down special, and that's what I was saying. Like, if somebody else is going to pay for it, it becomes a little more attractive. And usually, it's like if they're going to pay for that, you could have gotten the money somewhere else, but not always. So if there is a great deal like that, definitely worth taking a look at and having your loan officer explain it to you and walk you through that. All right. Moving on, for those of you who are getting the deck, break down all of the stats we've just talked about. Now we're going to look at county-specific data for the areas most of us practice in. Median sales price. So you can see here, median sales price, it was up overall for the DMV, and it was up everywhere except DC. But in DC, prices were driven down only by condos. If you were to take away condos out of DC, you would have median sales price appreciation. Both detached homes and row homes both appreciated. And you'll see double-digit jumps. Do I have enough time for... Okay, running short on time. I don't know if we have enough time left for my little boondoggle, but I'm going to go ahead and do it anyway because this makes no sense to me. Like, my mind literally explodes every time I see this data, and I want to get to the answer of it. I'm hoping each month someone can let me know what's going on. But you can see here, so Alexandria and Arlington, it's like, whoa, bonkers. Alexandria, median sales price up 11.5%. Arlington up 16.2%. That is serious appreciation there. And you suspect, okay, there's something going on. It's not that real property values have actually gone up that month. Usually it's distribution of assets, like property types. Okay, well, if prices are shooting up, more of these big developer specials of $3 to $5 million homes sold, and that skews the number. So I always like to take a closer look just so I can share some background, some color on why those prices are going up. And so this month, I'm going to do Alexandria. When you take a look under the hood in Alexandria, it makes even less sense. So here we go. Okay, these are the breakdown of home types here. And so, like I said, I still don't understand what is happening, but Tom Daly, who's a KWCP partner, former DCAR president, multiple-time Realtor of the Year, just amazing realtor and all-around good guy, he has told me that he will go to his connections, Bright MLS and Showing Time, and ask specific people who know what is happening here. I've been meaning to take him up on it. I'm going to take him up on it. I make a promise to you. I will know what is happening with this data by the time we meet next month. Temi, can you put a reminder in your calendar 2 weeks from now to see how I'm doing towards that goal? Okay, so breaking it down here. Here we go. Alexandria prices were up by 11.5% overall, and you can see that here in blue. But detached home prices were down 1.8%. Attached prices were up 4.4%, and attached condos were up by 2%. So how do you get an 11.5% increase when your two components that are increasing are 4, 4, and 2? How does that happen? Well, there's an attached all category. So let's take a look at the attached all category. Oh, here you go. Attached all explains it because attached all, whatever's in that category, those home prices appreciated by 13.8%. So, all right, that, a little lower in some of these other areas, and detached were down. So that makes sense how you can have an 11.5% increase until you do the math here. And I got to tell you, I'm a relatively new parent who hasn't slept well outside of maybe 5 nights in the past 18 months. And I worry that with the brain fog, with my extreme fatigue, that I'm just missing something completely obvious. And one of these days live, someone is going to point out that I'm just dumb, which I shouldn't say. We never tell my niece tells me we shouldn't say dumb. So not that, but so that's my worry, but I would love to just have the answer. So if I'm doing something wrong, something obvious, anybody knows, let me know. But here we go. So you have, when you break this down, you have 90 condos, 76 townhomes. That equals 166. Attached to all is 166. So how do you get attached to all up 13.8% when the two components of it are up 4.4% and 2.2%? You look at here, like 90 plus 76 equals 166, right? But then you can even take away, maybe attached to all is like this category from an alien universe where it's something is going on there. Just pull that out all together. If you have 90 condos, 76 townhomes, 39 detached homes, that equals 205. So those individual components equal all home sales. But you're getting an 11.5% increase here when nothing is supporting that. So I don't know. Market Stats, Showing Time, Bright MLS. Please explain this to me, because it mystifies me. Every month I will see pricing data usually that doesn't make any sense, and I look closer and it makes even less sense. And these numbers are just impossible. So please explain that to me. Okay, moving on. Closed sales. We talked about closed sales being up overall by 4.4%. Bit of a mixed bag. Closed sales were actually down in Nova, down 9.7%, in Alexandria, 9% in Arlington. There's Arlington and Alexandria, though, even when the data is accurate, it's tough to make proclamations just based upon objective, what you see the numbers, because they're such the real estate there varies so much between extremely affordable condos and really expensive single family detached homes. And so just a slight skew in those of the inventory that's available or what's happening. Usually it's like a lot of times what's going under contract in Alexandria and Arlington and then what's later closing is more more reflective of the inventory that has come on rather than anything with buyer demand. So just wanted to mention that. So closed sales were actually up everywhere in May, and they're up everywhere again except for Northern Virginia in June, though Prince George's County is a little bit close to even. Like I already said, don't expect this to continue. Pending softened in June, softening more in July. In addition to the conflict overseas, obviously for those of us who live here, we know that it's just been sweltering lately, and then we were covered with a blanket of smoke, and those things make a meaningful impact on buyer activity. It's so Maggie's asking, like, no, it can't, because this is their, like, that is their data set. They're talking about median price across all of those categories, and the underlying numbers of the categories just don't make sense. So, like, I'm within their universe, within their data set, talking only about median sales price, and it doesn't make sense. Things could not make sense equally, if not to go too far off topic, but if somebody was talking about, oh, prices are going up here, and someone else is saying, oh, no, prices are going down, that could very well be someone's talking about median price, someone's talking about average price. There like a lot of reasons why there can be a divergence with that, but that can't be happening here. And then also, like, going back to reporting your classification issue, it's like, it's possible, but also, like I said, you take away that attached to all, condos plus townhomes plus detached equal the number of units they say sold altogether. So it's like, regardless of what the categories are called, if you have, you know, those three equal the total, and that's all there is. It just, but yeah, no, but Maggie, I genuinely appreciate you. These are all things I stay up at night asking myself these questions. So it's nice to hear this is somebody else as distressed as I am. Okay, new pendings oops. Got so excited, lost my train of thought. So new pendings about even overall, but you can see they vary dramatically through the area. Frederick up a whopping 13.3%. Next highest is Prince George's County. A little bit of rebound there in Prince George's County. A little bit more buyer activity than there has been recently, but Prince George's County also was a little bit slower last time of year, and you have base effects affecting that. So Fairfax, Montgomery County close to even. Loudoun down almost 5%. Alexandria down 6.8%. DC down 8.1%, and Arlington down 10.7. So showing level, other than Prince George's County, like I said, showing some increased buyer demand there. Showing level was down across the board, though pretty close in Fairfax and Frederick. New listings. So last month, Frederick was the only area in the DMV with an increase in new listings, and that was really new construction driven. In June, they were joined by Fairfax and Loudoun. Those three were all up big, and those three areas are really what drove the DMV overall increase in new listings. I'm making up time. Active listings. So outside of DC proper, active listings are up everywhere and up by a sizable amount in most of these areas. Alexandria, Frederick, and Prince George's County up by more than 20%. And that kind of reflects what we have been seeing overall and what we've been talking about, just more inventory, a meaningful amount of more inventory in some of these areas. But important to note, even though it's big jumps from where it has been, still relative to where things were in some years or where things would be in an even market, that is not the case. Outside of DC, we are not in an even market. Classically, according to definition, in all of these areas outside of DC, we are still in a seller's market, and in a lot of them, an extreme seller's market. So DC leads the charge here at 5.22 months of inventory. Prince George's County is a little bit above 3. Everyone else is near 2 or under 2, and 2 months of inventory, extreme seller's market. Like I said, it might not feel like that. I get pushback a lot when I talk about areas being in an extreme seller's market. And like Arlington and Alexandria, people say, oh, no, you don't know what it was like in 2018 and 2019. It was just bonkers. I'm like, yeah, because they had less than a month of inventory then. So it's not as extreme, but it is still extreme. You've just been in some of these areas, you've been in a seller's market, a strong seller's market for so long that a not quite as strong, but still seller's market to some people feels like it's a soft market, feels like it's a buyer's market when it is not. Okay, median days on market. DC and Prince George's County have been battling for the top spot in days on market for quite a while. DC has once again taken the crown at 23 days on market. Prince George's County is, they're a little over 3 weeks. Prince George's County is a little under 3 weeks. Everywhere else, kind of just a little under 2 weeks or below. And you can see that Arlington, Fairfax, and Loudoun, half of properties are going under contract in about a week. So properties are still in a lot of these areas going under contract very quickly. Okay, now we're going to take a closer look at the 2 most recently reported weeks of July. Week ending July 5th, week ending July 12th. So new pendings, buyer demand appears to continue to soften, almost even in the first week here. You can see, but down 3.1 in the second week. I expect when we see third and fourth week of July for pendings to drop even more, combination of conflict in the Middle East increasing, and then also just the horrible weather and the smoke and all of that. I would be shocked. I would be shocked if we didn't see greater drops in pendings for the last 2 weeks of July. Showings down double digits each week so far. New listings were also down each week, 1.4%, 1.5%. Active listings up close to about 10%. So nothing here is earth-shattering. What we're seeing in July is what we were seeing coming towards the end of June and what you would expect if you were following the market. Okay, key takeaways here for both consumers and then also buyers, sellers, investors, and also agents. So I've talked before about, and this has kind of led the thing for the past few months, is that the conflict in Iran is really important as it relates to the economy and the real estate market. And it's kind of throwing a wrench in everything. And like I said, please don't take this as me being insensitive. I am a deeply compassionate and empathetic person. And I have a lot of thoughts and feelings about a lot of things. This is not the place for that. This is the place for economic and real estate data. And I'm speaking only within that lane. And it is just, this conflict is causing all sorts of turmoil in the economy and the real estate market. So if you want to have an idea as to what will be happening, just pay attention to that. And I've said before, just watch the price of oil. Look at the US benchmark, look at the Brent crude international, see where oil is going. If the price of oil is going up, things are not going to be great. Mortgage rates are going to go up. Transactions are going to slow. If the price of oil drops a meaningful amount, I mean, there's always fluctuation. If the price of oil drops a meaningful amount, you can expect that mortgage rates will drop and market activity will increase, both on the listing and the buyer side, because sellers and seller listing agents are very sophisticated and they're paying attention to these things too. And you don't necessarily want to list a property when the environment isn't going to be so hospitable to that. And then real estate overall. So higher mortgage rates are slowing the market, and more inventory is giving buyers a few more options, and homes are still selling relatively quickly with prices holding up. So it's like we live in a very interesting area with a lot of recession-proof jobs. You have not a lot of vacant land where property can be built. So even when the overall factors aren't so great, and you have a lot of real estate markets in the country hurting, here we have stabilizing factors. So you still have the market being relatively strong, at least compared to where it could be. And agents, the easy market is long gone. The easy market is long, long gone. Clients really need someone who can explain all of this to them and help them make an informed decision. Like I said before, a decision isn't wrong if it's informed. If you understand everything that is happening and make a decision based upon that, that's the right decision for you, but just more important than ever to get that information. Buyers, you have more choices, more negotiating power. But if you're waiting for the perfect market, you may be waiting a long time. And whenever you stop waiting, you're probably going to pay more for the house than you would have overall. So the waiting game isn't necessarily having dividends for buyers. And then sellers, still a strong sellers market outside of DC and Prince George's County. Many buyers are still out there. They tend to be a little bit pickier. It's interesting. It's like, perception is reality. And you do have a lot of buyers who are reading articles about the market being soft and inventory shooting up. And so they are being a little more particular sometimes than market forces would dictate. But that is happening. But if you price it right, present it well, it should sell Condos will take longer. Condos in DC may not sell at all. Actually, I want to add that caveat to that. If you can price it right, you can present it well, and if it's a DC condo, it just might not sell in this market because there are so few buyers out there. Okay, wow, 1 minute over. Made up some time there. If you have any questions or comments, and this is, going through this, I'm not going to stay on this slide for very long, but you can always go onto the video and get my contact information. Feel free to shoot me an email, shoot me a text if you want to get on the distribution list for this deck. Temi, technical difficulties, Koji. Would you like to? You get a little bit of grief from me today, but like I said, I just want to reiterate, I love you. You are the best. So wonderful to be colleagues with you, and great having you on here. Is there anything you would like to add related to what we talked about, things you've been seeing, and just so people know who don't know Temi? I mean, Temi is a elite top producing realtor, and she is just helps a lot of clients. And so just her personal knowledge, even if she didn't pay attention to anything else, just her personal knowledge from the transaction she is dealing with would be extremely valuable. So anything you'd like to share, Temi?
No, just reiterating what Maggie said in the comment section of just, and then what you also said was just, making sure that we are really there for our clients right now, like understanding what's going on in the market, shifting when we need to shift. It's not always easy to know like all that's going on every time, but like just be in constant communication with our clients on a weekly basis so that we know when to shift, especially with our listings.
Mm-hmm. Absolutely. Thank you, Jaleel. Thank you, Maggie. Thank you for everyone joining here. This is like I'm not gonna lie, sometimes this stresses me out if I like have a lot going on, not sleeping, getting prepared. But I really love this community that joins on these sessions, and I love hearing from you. And I also like, you can drop in the comments, you can reach out to me directly. I really do want this to be as tailored as possible to the needs out there of, primarily agents, but then also people looking to buy or sell. So if there's stuff I'm not covering, if there are questions you have, just, reach out to me in the comments or email or text. All right, we are over. So I'm going to let everyone go and have a wonderful rest of your Thursday, incredible weekend. We are about to have some beautiful weather. Might as well go on a segment here. I got a little bike trailer from a little girl. We've had it now for a couple of weeks, but with weather, don't want to overheat the little kids, and the smoke, haven't broken it out yet. So she might be going for her first little bike ride this weekend. So I'm excited. Hopefully everybody has something kind of nice and enjoyable or relaxing going on this weekend as well. All right. Thanks all. Thanks, Temi. Take care.